The single biggest weekly drop in the S&P 500 last year was just under 15%. Now, for someone following the FIRE approach or coming up to retirement, FIRE is financial independence, retire early, which basically involves saving as hard as you can and being as miserable as you can, buying ETFs and low-cost trackers until you've got enough money to retire. That's FIRE. That's potentially years of saving wiped out in a matter of a week. Now, it came back, and last year, the S&P finished up 18% close to 19, I think. But here's the thing, in my opinion, that no one's really paying attention to at the moment. What if it had not, or what if the drop was much, much larger than 15% and took much, much longer to come back? What if you were close to retirement and the CAPE, cyclically adjusted price to earnings ratio, which is the most accurate measure we've got of the overvaluation or undervaluation of a stock market, was sitting at 42. Spoiler alert, it is sitting at 42 now. This is just below the level it was sitting at in 1999 before the dot-com bubble, where markets lost, or some markets lost, over 70%. And to give you a comparison, the previous highest figure we'd seen was 37, which was months before the Great Depression, where markets lost 80-odd% in the 1930s. Now, today I'd like to run you through the maths behind using property and taking some of your gain from the stock market and crystallizing it in an asset such as property, where using a mortgage or leverage, you can increase your returns to being equal with or more than the stock markets, in an asset that will also pay you a consistent monthly return regardless of what the CAPE Shiller's at and regardless of what markets are doing. So a quick explainer then on the CAPE or the Shiller to give you a bit of context. CAPE stands for cyclically adjusted price to earnings ratio, and is also called the Shiller PE, price to earnings. Nobel Prize winner Robert Shiller came up with the concept, or the ratio. It measures whether a stock market is cheap or expensive relative to a 10-year average. And you could think of it as an example, if you know property well, like a price to rent ratio, for example. If someone's asking £1 million for a house and the rent is £1,000 a month, then that is an extremely high number, which would suggest it is overvalued. Since records began, since this number began 155 years ago, the average has been 18 to 17, or 17 to 18, I should say. Today, it is sitting at 42, a number only ever seen once before. The numbers then, what do they mean? 15 or below means it's cheap, let's get in and buy. 15 to 25, fair value. 25 to 35 should be seen as the warning zone. 35 plus is the danger zone. The GFC, global financial crisis, for example, before that happened, we were at 37, and 42, where we are today, the second highest reading in 155 years. Looking at some previous examples then to see how much markets fell by markets fell by after certain Shiller numbers. Great Depression, the reading was 30 odd, markets fell by over 80% from their peak. Pre-dot-com bubble peak in 1999, the number was at 44. The S&P fell over 50% and the NASDAQ 77%. Pre-financial crisis, GFC, the number was 27%, and markets fell, say, circa 50 to 55% globally. Now, I'm not here to tell you markets are about to crash. I'm not a financial expert, but I do love data and graphs. And if you look at the data and the graphs and the research, it would suggest that markets are overvalued and a correction is due. Now, it's my belief that in times such as this, you need to have more of an allocation to non-correlated asset classes, i.e. that are not correlated to stock and share markets or equity markets. You know, a traditional example of that would be gold as a store of wealth. Some people see Bitcoin as that new store of wealth. Another example is property, where you are going to get that fixed return from the rent each month, regardless of what is going on with equity markets, because people still need places. Now, yes, the dynamics might change in a recession, and you might need to target and buy slightly different property, but the principles still apply. Now, a lot of my friends that are in equity markets or ETFs, I know what they say. They say that property only goes up 45% a year if you are lucky, which pales in comparison compared to the 18% in the S&P last year, for example, or the near 100% over the past 5 years in the S&P. And that is exactly right, but I think one thing that a lot of people miss if you don't understand or know property that well is the power of leverage. Now, that is the fact that you can buy 100% of an asset or a property using mainly someone else's money, aka the bank. You can put down 25 to 30%, but you control 100% of that asset, and therefore your 4 to 5% then becomes 16 to 20% when you are using a leverage. Now I'll show a comparison here, which is £50,000 into the stock market and £50,000 into a property to see how they do actually stack up. Stock market then, £50,000 into the stock market over 5 years. If you look at the recent run, the bull run, I don't know if it is a bull run, but we've seen rapid growth, 80% plus. Your £50,000 would be worth £90,000 now. Absolutely fantastic. And for not having to manage anything, just leaving your money there, that is an absolutely brilliant return. Total return on your cash in that example, 80% or 16% per annum. Is it a correlated asset class? Is it correlated to the markets? Yes, because it's invested in them. Income generated? None, because we are reinvesting and compounding that. Compare that to property then. £50,000 buys you a £200,000 property, and this is simplified. I haven't included all the costs just to keep it simple, because that'll take ages. If you'd like those, let me know. I could send you a spreadsheet. If you're looking at the most recent house price report from Savills, they're suggesting 22% odd growth UK nationwide over the next 5 years. It'll be different whether you're in London or the North East or the North West or the Midlands. It always is. So if your £200,000 property goes up 22%, that is a £44,000 gain. Now on your actual money deployed, that is an 88% increase, or 17.6% per annum, which now is on par with stocks and shares, and that's before you take into account the return from the income or the rental income from the property. Is it correlated to equities, stocks and shares? No, it's a physical, tangible asset. Do you generate income from it? Yes. Let's say £1,000 a month, obviously you've got your costs to cover from that. This is the same starting amount of money, but a totally different situation in 5 years' time. The income stream from property is totally uncorrelated to the S&P 500 or equity markets, and it doesn't care whether they're sitting at 4,000, 7,000 or 9,000. Now, how do these two stack up from a volatility perspective? If you're looking at last year, the single biggest weekly drop in the S&P 500 was just under 15%, if I'm correct, and depending on the data source you look at. That was in a week. Looking at UK property as an example, the biggest drop on record that I could find was 1.8% in a month. What's the summary then, the closing on this video? It is hopefully to show you that if you have achieved great gains in the stock markets over the past 5-10 years, and you are conscious or cognizant of the fact that the Cape Shiller is sitting at an almost record high, it may be a time to reallocate some of that into property. And if you are a devout FIRE person or ETFs person, hopefully understanding the element of leverage and how that increases your returns in property may help show you why and how you can use property to balance your portfolio when markets are looking overvalued. Key points in summary then, the Cape or Shiller is now sitting at 42, only ever been higher than this once before in 155 years. Leveraged returns on property take 5-year returns from 22% to 88. Leveraged returns on rental income take the yield from 6% to 24. And yes, it's very simplified. There's no management in ETFs or stocks and shares. There is with property, but if you have the right team around you, you don't have to do all of that yourself. I'm not a financial advisor. This is not financial advice, just my opinion based on the research and my experience of being in property now for 12 years. If you're an expat with stock market exposure or heavily weighted towards stock markets and you haven't thought about property and you'd like to talk about property, then drop me a message. I'd be happy to have a chat with you or send you a copy of our book, the Expat Property Playbook, that shows you how you can do that. Link below.